Hi, everyone. Thanks for having me. Pleasure to be here. So I like what you said. Well, when you started, it said, you know, cross-border transfers of payment as well as assets. And I think that's the most important thing to consider. Like, it's not just the ability to send a token that, could be used for payment or, you know, effectively, but, these are all utility tokens. What's important is the innovation that blockchain has created allows us to transfer all sorts of assets. And let's talk about, very specific examples, because, rather than give a generic comment, I'd like to give a really specific example that paints the picture. Think about patents or IP rights today. These are licensed across hundreds, if not thousands, of companies. And there are hundreds of patent offices. Each country has their own. In some countries like the United States, you can get some very specific state level patents as well. And so think about the butterfly web this creates. You have a very large amount of people who own and license these patents. You have a very large number of people who issue these patents. And these are all on disparate databases. The only way to create, a marketplace where anyone can exchange these assets, whether it's licensing or transfer, is to use a third-party database or system, in this case, a ledger, like a blockchain, that no one controls and is immutable. Therefore, no one's scared that, the transfer can never be detected later. No, everyone's willing to share some data with the underlying blockchain because, you've created an efficient marketplace. And therefore, you've, by and large, created an extremely efficient system that you otherwise wouldn't be able to, because no one is going to trust a third party with reconciling and ensuring immutability of these underlying transfers. But when it's a public immutable ledger, which has been proven over the last decade to be highly resilient and secure, people are more willing to do so. So blockchain technology, acting as this, trustable public network, allows us to transfer all sorts of things across borders, across economies, and across differentiated tech stacks. Thanks.
Yeah, and I mean, certainly, again, this is something that we continue to see develop. It's obviously a very fast-moving space. Alon, given the experience that you have, the background that you have in crowdfunding and different types of innovative funding solutions for companies and for finding ways for ultimately wealth to be transferred or invested, what are some of the opportunities that you see in this asset tokenization? What are some of the practical implications for those of us who are in the investment management business?
Yeah, also thank you for having me. Unpacking what you just asked for. So when it comes to the transfer of wealth, but also wealth management, what I see is the ability to truly do cross-border in a meaningful way. Because right now we're used to, pre this last year, we're used to doing these transactions after meeting each other, after traveling across the world, after having lawyers look at each set of documents, making sure I'm allowed to invest in your deal on your side of the world, you're allowed to participate in my side of the world. There's all these different regulatory hurdles. There's all these different technological hurdles. There's definitely the trust hurdle that Mrinal just brought up. And, where the opportunity, I think, lies in all of this is sort of twofold, many more than twofold, but in this conversation, twofold, right? Like what Casper is bringing to the table too is really exciting, because most technology first, before we even dive into the real specifics, gets adopted by the enterprise before it gets adopted by the consumer, before we all bring it into the house. We started using email at work before we trusted it and used it enough to bring it home. We started using computers at work before we brought it home. And this cycle has evolved with almost every piece of consumer technology we've ever had. So it makes sense that we start with business and we start with work, we start with the enterprise. And when it comes to the enterprise, doing cross-border and cross-world is the most complicated and most expensive. And it's the easiest for blockchain to solve because it is no different for me to be online with you guys on the other side of the world right now. I'm in Southern California. I know some of you guys are in Dubai or Abu Dhabi, and Mrinal is somewhere in the United States in between us, right? So it's no different, right? And what blockchain does and what this can enable is the lightening of the load, and the technological advancements can take all of the regulatory hurdles, can take all of those global hurdles, the legal hurdles, and make them much, much smaller, to where every investor can invest easier. Every company who's raising money can raise money easier. And that's where it comes to me from the crowdfunding space. But the regulation, no matter what country we were dealing with in the crowdfunding world, regulation was a big wet blanket on our industry. It slowed us down tremendously. And the technology existed to say, you know, okay, we're going to take the rules and regulations of the UAE and the rules of the regulations of the United States, and we can build technology to streamline that process. But only if the people transacting trusted that technology and trusted that it was legal, from a lawyer's basis of, okay, the docs are legal, clicking this button is legal and things like that, but also from a regulatory standpoint was legal. So it's like, when I clicked okay and my money transferred, will regulation come back to bite me because maybe I wasn't allowed to do this transaction? Maybe I'm not an accredited investor, or maybe the person who invested in my company wasn't actually accredited. And so now with these processes and with the trust layer, that can be enabled much, much easier.
So Saeed, with your background in Alphabet, at Binary, you've been actually in the thick of it, executing these types of transactions, investments, cross-border, using blockchain technology for several years. You've been quite ahead of the game, having launched some of these products and investment strategies before there was such a huge focus on the industry. How have you seen the blockchain add efficiency to the investment process as a fund manager, as an investor, and where do you see continued room for improvement?
Yeah, great question. So I think with blockchain, what it enables ultimately at heart is that it removes the need for middlemen, especially in financial transactions. So, ICOs, if you look back to ICOs, they were revolutionary because they disrupted the crowdfunding model that the traditional world was used to. So rather now, if you wanted to join into a new, company that was issuing a token as an asset to invest in, then, you can do so from your laptop, and, you can use as low an amount as you want. And, that just streamlined the investment kind of process and made it, like you're signing a peer-to-peer transaction directly with the founders of these startups, which before 5-6 years ago, before ICOs existed, was not heard of. So definitely, what the beauty of blockchain is, I think, is that, because of the many different efficiencies that it brings to a lot of different activities and transactions, especially financial ones, that's there for everybody to see. And I think over the years, when I first got into the space, colleagues at Adia were telling me, like, you're crazy for leaving one of the best paid jobs in the world and venturing into blockchain and crypto, and it's like nobody knows about it. But I was like, I believe in it, and I believe that it will change how we transact globally, across borders and across countries and across jurisdictions. And like, the technology is developing at a rapid pace. But I think now we're seeing more and more kind of regulators and jurisdictions kind of try to put regulation around these transactions, which is good to see, because ultimately that gives us legitimacy in the activities we carry out as investors and traders and speculators in the market. So I think that's a huge thing for us.
So, Saeed, you highlighted the fact that one of the powerful impacts in reducing frictions comes from the fact that middlemen in several of these potential transactions, whether it's originating or primary transactions, secondary transactions that may be happening post-launch, are effectively disintermediated. Now, Mrinal, one of the things that we discussed was that to me as a banker, as an investment banker, as a fund manager, also means someone out there in the market is losing revenue, right? Somebody's getting cut out, somebody's losing an opportunity to make money. How can businesses, how can investment banks, how can brokers, how can financial services companies, founders look at the revenue opportunities that are being created, the creative destruction that is happening through this technology? How can they capture new revenue opportunities by tokenizing existing or previously overlooked assets?
Yeah, I actually think this grows the pie for investment bankers and the traditional finance industry. Like, while it's been very, very disruptive to date, if you think about the offerings, they've typically been for layer one protocols and more esoteric, not esoteric, more traditional assets like equities, mezzanine debt, real estate, etc., haven't really made their way onto the blockchain. So almost to say, like, all the capital raised within the blockchain industry has been for the blockchain industry. It's not been, the traditional assets that all of us are used to acquiring and owning. And this does require processes, right? Like, if you think about it, like assets like equities, real estate, etc., there are like I don't think I do think because of the disruptive nature of the technology, things will change slightly, but many of these still require a level of management, right? Like, it's not like tomorrow a public offering of a company is not going to require an S1. And who puts together an S1, right? It's investment bankers and people on Wall Street and people who know about this, and that requirement's not going to go away. Sarbanes-Oxley compliance, that's not going to go away. So when we think about, where the majority of assets sit, which is across debt, equities, and real estate, these three things aren't actually being heavily transacted on blockchain yet. And the reason why is the ability for blockchain and enterprise to kind of meet and, ensure that we're complying with relevant regulation across the world hasn't yet happened. I think it happens pretty soon. And when it starts, it's going to hockey stick. It's taken longer than most people expected. But as with most technologies, that's what happens, right? It takes a lot longer than you expect. But when it does happen, it goes a lot faster than you thought it would.
So this actually ties to a question from the audience. Babar Malik has asked about physical asset tokenization over blockchain, and some of the concerns that he's highlighting relate to jurisdiction, regulatory issues between jurisdictions. Now, Alon, this is something that you touched upon earlier in the discussion. For someone who's considering either intermediating or offering deals via a asset tokenization model, what are some of the, how do you think they should get started from a legal perspective? What do this is something you've experienced. Where do you get the ball rolling? You can easily, spend hundreds of thousands of dollars on lawyers and find out that you can't do anything. So how would you recommend people get started if they're thinking about potentially implementing a transaction?
Yeah, I just, before I even jump in, I want to double down on what Mrinal said on the last comment, and coming from the perspective of where you're standing, Zachary. You mentioned investment bankers in particular, and I think that in my last startup, I remember doing research into a product we wanted to launch, and we realized that the alternative investment space, just that one category in the United States alone, and this was a few years ago, was a $7 trillion category. And that category, a majority of the money in that category was raised by licensed bankers. Series 7, in the United States, Series 7, 6, Series 63 bankers that had their licenses hung, so to speak, at different broker dealers. And what we learned was the biggest problem, and blockchain didn't exist in, at least in the way it does today, in how we would fix that solution. But what we wanted was a network of bankers to be able to share and promote deals using the internet, because the internet can amplify all of these things, can make your book much bigger and make you be able to share deals with your investors that couldn't be shared before, and that you couldn't collect your commission on before. Right? So if you're focused on real estate, but your investor comes to you and said, I want to look at a venture capital deal, you didn't have a deal you could show them where you would collect a management fee on, or collect some kind of success fee on. But imagine a world where you could trust sharing your Rolodex with a platform, because you can actually see you're not going to get circumvented. Your biggest asset of anything that you have as a banker is your Rolodex. But if you can't trust the person you're sharing it with, which is why, you know, bankers hold tight to their contacts, you're not going to be as free to share deals and opportunities with your whole group or with other bankers. But imagine being able to participate in a network where you know that if you invite Mrinal to a platform to invest in a deal, even if they invest in a different deal 3 years from now, as long as you're still licensed, as long as it's still legal, you can collect your commission on that. All of a sudden, there's more opportunities for you to earn revenue. There's more opportunities for you to be more free with your data and sharing opportunities with groups, and you'll probably end up making more money because of that over time. Maybe fees will get crunched because you'll have to share some of those fees with the platform, but imagine being able to amplify your book 5, 10x, but your fee only goes down a small amount. So it's an exciting opportunity. Now, talking about the legal and bringing people online and cross-border and all that, you've got to start with your lawyers. You got to have trusted lawyers. You got to do it right. You've got to do it properly. But at this point, even at the experimental phase of what we've seen with asset tokenization and securities tokens, or digital securities, as some people will call them, or digital shares, there's sort of different names, but they're essentially the same thing, a security that's digitized on the blockchain. You'll find that some of the largest law firms in the world have done some of these deals at this point. So if you don't have a lawyer that already knows this space that you trust and work with, you may be able to go to one of those very large firms that you do trust and you probably have worked with in your career, and they'll have a practice or a group that does this. So you know, there's a few lawyers I know off the top of my head. I don't want to solicit anybody specifically, but if you reach out, you know, I can connect with a few lawyers I've met over the years that are in this space that know what they're doing, that won't tell you no because it's scary to them, but they'll tell you, okay, here's how to do it. Here's the hurdles. Here's the pitfalls. You know, what's great about the digital securities regulated side of things is that you're not doing anything super controversial. What you're doing is taking an existing security, you're enforcing regulation, and you're digitizing it. Now, if you want to create a utility token, do something like that, get into the sort of DeFi gray area of things, then you're even more important to talk to that lawyer. But you're not doing anything too crazy, and governments are starting to approve and sort of give no action letters to people who are doing it correctly, and doing it in a regulated sort of way. So there's more and more clear guidance every single day. But what I would say at the beginning is go with a trusted blockchain, with a trusted lawyer. Don't, you know, make sure you're using tools that are meant for what you're doing, not just, you know, public craziness. If you're doing that regulated security token, maybe don't go to the ICO public blockchain that's not meant for enterprise.
And I mean, just going over to Saeed, if you certainly would like to add anything to the above, particularly if you could maybe, for those on the webinar that may not be as familiar, highlight some of the key differences between what an ICO is and what an asset tokenization or digital security might be. And I also wanted to understand, your view on actually creating liquidity around these instruments. Does putting an instrument on blockchain mean that there's magically a pot of liquidity that's waiting for these assets, or what are the practicalities of these assets actually becoming liquid?
Yeah, great question. I think, so in terms of, what I would say is I would break it down into two parts. So that you have the utility tokens, which are usually offered via an ICO, and then you have security tokens, which are, as Alon said, they're just simply assets that already have rules and regulations around them, and you're just digitizing them and putting them on blockchain, and the ownership of it and the records of it all on blockchain. So that's the difference between a security token and the utility token. Now, you hit a great point, and one that I think is super important for security tokens and asset tokenization, and that was around liquidity. And right now, I think if the quality of the assets that are being digitized is there for everybody to see and actually in demand, then I think the liquidity will come because of the quality of the assets. However, over the last few years, I think it's been kind of, with the asset tokenization space, it's been more of an experimental phase. And I think you're seeing the smaller asset owners, taking a risk on the technology and the jurisdictions and the regulations around it. And, they're putting in smaller assets, which might not be in quite as high a demand as other high quality assets. So let me take an example. Like if you think about EMAR in Dubai, right? If they say, okay, we're going to tokenize Burj Khalifa or one of their prime assets, then for sure you're going to see the interest there, and then you'll see people putting in liquidity, and you'll see the secondary market move on it. But I think it's just a question of the big asset owners are kind of sitting on the fence and waiting, for the smaller asset owners to make the kind of mistakes and take the early risks with adopting a new technology. And over time, that's why it's taking time, because I think the big asset owners, they usually have their processes and policies and boards to kind of consider before they make any kind of big decision like that. So I think liquidity is definitely a very important thing in security tokens. But I think over time, you'll see that slowly coming into the market organically.
So, Mernal, Saeed highlighted some of the main issues that are concerning to anyone who's considering security tokens or any kind of token around liquidity. I'd like to understand what do you see as some of the other additional challenges to liquidity around tokenization? How do people take a pragmatic view? I think there are a lot of people who just think, sprinkle blockchain and suddenly liquidity will appear. And that's
Right.
certainly not the case in practice. We've seen a lot of instruments really struggling to gain liquidity. So what are some of the key differences between those that have attracted significant liquidity and those that aren't attracting it? What are some of the key considerations that a potential sponsor, promoter of an asset-based token may need to consider with respect to whether or not this will actually be a liquid instrument?
Yeah, so it really, like, if I would boil it down to like why it's not taken off the way some people are saying, is it really comes down to governance and recourse. We don't have the systems that allow for adequate governance and adequate recourse. And so let's talk about each one separately. So think about governance. So you have a smart contract out there, like Saeed said, which allows someone to buy the house, but then they start defaulting on the mortgage. Who are you able to actually have an arbiter or a court change the outcome then and return the house back to someone? And what blockchains haven't had to date, and there's actually a feature we have in the Casper network, but not an advertisement, but like if you think about like governance, what you need is to have a system that allows you to appropriately weight certain people's ability to weigh in on a decision. So, for example, in this case, house transfer, maybe say it was in Dubai, maybe the housing board there has a disproportional weight in that smart contract and are able to reverse it if something happened. And so as a result, you can actually build your smart contracts in a way such that the recourse that people feel they have in the real world is also still available on the blockchain. It's still immutable. It is still completely transparent. Everyone sees how every single part of the transaction happened, but we've added a level of flexibility and governance that hasn't existed today. So that's on the governance side. And then on pure recourse, one of the biggest things that hasn't really occurred within the blockchain industry yet are insurance products. The reason why we're happy interacting and buying securities and doing all sorts of things in the traditional world is there are a ton of insurance products which help you mitigate risk. You know, people write out the actuarial tables and figure out, you know, what's going to happen. Because this industry is new, which is why insurance products haven't come, and the transparency and governance of the underlying smart contracts is a little bit opaque right now. But as those things change, I think a lot of insurance and other, you know, similar products will come into the industry, and then this combination of governance and recourse will make people feel a lot more comfortable with things. But in my opinion, it really just boils down to those two things not really existing in a meaningful way today, which is why things haven't taken off as much as, you know, the participants in the industry would have hoped.
I mean, Alon, I'd love to hear, you know, your insights. I mean, you've been in so many deals in crowdfunding. You've originated a large volume of transactions. What can you add to that? What are some of the key differences, the key ingredients? Is it, you know, really just a matter of governance and recourse, or are there other considerations as to which instruments end up attracting liquidity, secondary market, and which ones do not?
I think that, you know, they're hitting the sort of technological governance and recourse side, then the liquidity side. I think that, you know, what Renal highlighted is a big reason why certain assets from a large institutional standpoint haven't hit the blockchain yet, right? Because giving the single example that he gave in terms of mortgages or things like that, you know, that is a huge problem, right? Like that, the fact that a smart contract is a smart contract, at least the simplest, and to use, you know, the terminology, like the dumbest form of a smart contract is amazing, right? Like the fact that it's like the if this then that kind of statement is wonderful. But what happens if that statement means that my car needs to be repossessed? Like what really does happen in real life when that happens, right? There's so many things. So there's real world service providers and situations and arbiters that can be enabled in those cases. And then essentially you're becoming like a bridge between the online smart contract blockchain world and the offline physical world of the person who will go to that place and take that car back or whatever, as a really, really basic example. But those kinks that need to be worked out in the system are a big reason why, you know, like Said said, the smaller assets, the people who are experimenting more, are the ones building the experience for the larger institutions who will come in and eventually do it. Now, when it comes to the liquidity, I think that is the big first part, right? Because liquidity rides directly on the back of assets that people want to transact with. So if the more traditional, more safe assets, safe, you know, in the traditional world, maybe. We're all in this space for various reasons. So we might be in this space because we think that that world may not be exactly the safest in the long term, but it is the world we live in today. You know, if those assets don't come onto these exchanges, onto these platforms, onto these places, then there's going to be less liquidity. Because again, even with ICOs are this amazing thing that, like Said kind of touched on, because of the fact it's the first time ever, in a way, that startups, at least, or even if they're organizations, ideas, and utility tokens, and not necessarily startups in the way we thought of them before, but sort of, brand new ideas actually have liquidity for the first time ever. In the years of crowdfunding existing, there was never really a proper liquid market for startups ever. That's just now starting. It's just inklings of that. And so that's the holy grail. And those more traditional type of investment opportunities need to come to the space to add to that. But what I'll also say is that blockchains and the platforms need to be set up to be more professional and built for the enterprise layer and built for cross-platform transacting and cross-border transacting. So getting back to the cross-border example, if there is no operability between the banks and the exchanges and the assets, then people aren't going to transact. I log into my Wells Fargo or Bank of America or Union Bank just like somebody might log into their Schwab account. When you log into your Schwab account, you can buy a stock that's on the New York Stock Exchange. You could buy a stock that's on NASDAQ. You could buy a stock that's on the London Stock Exchange. But in the blockchain world so far, with the sort of experimental phase, everything tends to live in silos. So like a security token will be tokenized by one platform and on one exchange. But if I'm logged into my other banking platform or my other account, I can't really transact unless I go do my KYC and AML and all that stuff on that platform. And that platform has to be enabled to be doing business with me in my country where I live. And I might have to be an accredited investor or not an accredited investor. Or, if I'm based in the United States, I might not be able to participate. If I'm an accredited investor, I might be able to. There's all these rules and laws and regulation, but they all live in silos. And if there isn't an interoperability layer that says, oh, this asset was tokenized on Casper, but my bank doesn't use the Casper chain, how do I participate? Do I have to send my passport and documents to that other exchange that's built on Casper? I think that there's going to be more enterprise-focused solutions, like a Casper. Again, I keep using the example because Mrinal is on here, and it's a great example, right? But then there might be other products like the people, and it might not be because the other platform is better or different or whatever. It's just the platform they use. Or maybe I don't agree that it's better, but the only way to get that asset is to interact with it. Today, there's no sort of APIs and layers and opportunities to do that in a trustless way. There's starting to be, and that's where it's going to get really, really exciting. But it all starts with proper assets that everyone wants to go to, that they feel safe investing in, and those are going to be done on the backs of blockchains that were built for that purpose, and a good legal structure, of course.
So, okay, so we've highlighted several key things for there to actually be liquidity in these, security tokens or these assets that are being tokenized. We discussed, the importance of governance. We discussed the importance of recourse over that asset, the ability to actually benefit from the cash flows. We talked about structure. We talked about, again, that these have to be assets that people want. If you take something that nobody wants and you sprinkle blockchain on it, it's not going to suddenly create this desire or interest in that asset. It needs to be something that people actually want. We need to make this more professional, more accommodative enterprise. This needs to be more cross-platform. You discussed, again, the different platforms in different jurisdictions. There are legal, regulatory, technological silos. And, to put it simplistically, I think we need, there will always be some silos. We need pipes between those silos that can actually allow things to flow through from one silo to another. Now, I think that we also have to address that there is actually, I think, an ingredient missing from that. I'd love to hear Saeed's view. But an important part of liquidity in, let's look at the most liquid markets, the public markets or FX markets, is, information, right? When are the most liquid events in any market? When do they trade the most? Is when there's new information that is relevant to that asset class, and the market basically trades that asset class as part of a price discovery process, right? It needs to rediscover what the price is of that asset class, and that happens through the process of intermediaries that are processing that information, trading, discovering and agreeing to effectively a new price. Now, when we're talking about startups, when we're talking about a specific real estate asset, or when we're talking about a lot of the assets, the new assets that people might want to tokenize, what are some of the practical implications or practical limitations to? I mean, we can't expect a small startup to be basically holding itself to the public and information disclosure levels of a large publicly listed company. So, Saeed, I'd love to hear your view on kind of the barriers to information that create a challenge to price discovery that results in potentially less liquidity coming into tokenized assets that don't have the capability of kind of disseminating that information for the market to discover price.
Yeah, great question. I think what's most important is the infrastructure and the ecosystem around which the existing financial transaction structure is built on. So I think if through blockchain there is a kind of network or platform which can help with building an ecosystem and developing the infrastructure, so that, for example, in the case of Casper, I'll mention, for example, if all of these broker dealers, insurers, and all the different parties that are present in any financial transaction, if they were all connected to a system which was interlinked by blockchain, whether it's one blockchain protocol or several protocols, and they can talk to each other and interoperate, then this network of people that are involved in the chain of a financial transaction, they can communicate to each other through the blockchain network, and things will be much more efficient and seamless and easy to do. Like the example Alon gave about the bank, if all banks had a blockchain infrastructure that they were utilizing that was connected to all the investment bankers, all the traders, all the broker dealers, the asset owners, and everything is flowing in terms of the transaction data and the data points, then I think that will make a huge difference. But at the moment things are pretty fragmented, and like one provider might prefer a certain blockchain network, whereas another provider might prefer the legacy system. And I think connecting the legacy systems to these new blockchain interoperable systems is very important, and that will help facilitate a lot more financial transactions, even if they're startups or new assets that are coming into the market. So I think especially with the bigger players that I mentioned in the financial industry, if they can see that the infrastructure is there and well developed, and blockchain technology can facilitate transactions much more efficiently and cheaper for them, then of course they'll use it. So I think infrastructure plays a big role, and that's why you're seeing some issues in certain markets.
So, as many of you on this call may know, here at Dalma Capital, we were among the first investment banks to actually implement and carry through a transaction on an asset tokenization. We worked very closely and advised with the lead advisor to Bank of BTG Pactual, and helped to tokenize some of their assets on initially Ethereum and then the Tezos blockchain. And that deal was successful. It was a couple of years ago. It was very early. It was a very interesting learning process for us, and we looked at public chain as the venue for tokenization of that asset. We've also, again, been very closely monitoring the Project Hash program, which has been launched by SGX in collaboration with HSBC and Temasek, and are very interested in discussing with issuers the potential to utilize that private chain, which takes advantage of a lot of the technologies that we've discovered with blockchain, the ability to issue bonds and other financial instruments in T0 with atomic swap and so on and so forth. And they completed their first digital bond last year with OLAM International successfully. This was a $400 million bond issuance. It was very much actually a traditional asset from a very large enterprise. Now, again, Mrinal, I'd love to understand, we saw we had to look at potential benefits of public chain versus a private chain, and there are benefits and drawbacks of each. Now, I understand core to what Casper Labs has been doing has been building solutions to hybridize these and to address some of the concerns and limitations that issuers, investment banks, participants in the potential asset tokenization market have with, with doing something exclusively private chain or exclusively public chain. I'd love if you could, first kind of give us an overview of what the problem is, right? What's the problem with the public chain? What are some of the problems with the private chain, and what the potential solutions are for hybridizing those, and how those address the problems that have kept a lot of issuers out of the market to date?
Yeah, absolutely. And first, just to give some background, right? If you think about systems that have been more open and public, they've always taken this hybrid approach for them to really hockey stick. So take cloud computing, for example. You can choose which parts of your infrastructure you keep private and bare metal, and which parts of your infrastructure you host on AWS or Azure. And that's why this thing took off. If it wasn't, you can only be 100% AWS, or you can only be 100% bare metal. AWS wouldn't have taken off the way it has. And you can extend that example into lots of things like distributed storage, application stores. If you look at like the way software is deployed, it's almost always in a hybrid setting. So now let's bring it back to blockchain. What are the benefits of public and what are the benefits of private, and why is hybrid really important? The benefits of public is no one owns it. Therefore, if there's data that needs to be posted that is useful for distributed actors, but they don't want anyone to centralize it, it's super useful. Two, it's immutable. It can't be changed by anyone, because since no one owns the instance and the instance is owned by a distributed set of validators across the world, you know that there's no reversibility of transactions. However, it's out in the public, so there might be data that you're unwilling to share with the public. Now, what's good about the private side? You manage it, you know exactly what the infrastructure is, and you have a certain set of controls over it. Now, here's a question. Why would you use a private blockchain if you don't have the benefit of the public blockchain, which is the trustless and public nature of it? And the answer is you actually shouldn't. You should just use a database, because a database is far more efficient and computationally more efficient. However, if you are taking advantage of the public blockchain in any way, you probably want a private instance, so you're replicating data structures, meaning your ability to query what happened is exactly the same in your public and private setting. So let me bring all of this together with an example. So let's go back to the patent registry we were talking about. What do you want to be public? You want who owns a patent, who has licensed the patent, and how long does that license last to be public? Because that way it's queryable, you've created a marketplace. What do you not want to be public? How much did the person pay for the license? What were the terms of the license? Were there any other provisional items around the license that are germane? Like, for example, you're allowed to use the license, but only as long as software development with my company continues under, statutes XYZ. And so what you do is you create a private instance of the Casper network, and where you store all the data. But the chain of custody of who owns the patent and who has the license is put out to the public network. And now you have the same data structure in both areas. They're both queryable, meaning if you want to look up what exactly has happened, you can do it very, very easily. And you've solved the problem of, hey, am I going to go 100% private or 100% public? No, you actually need to do both, just like you do with cloud computing today. And that's what we're huge believers in. Like, if enterprise is really going to take this industry seriously, you have to give them a way to get all the benefits of the public ledger, but also make sure that they are consistent with their business practices and are able to keep what they want to keep private.
So, Alon, can you maybe add to? I mean, we discussed the potential for different types of assets that can be tokenized. And can you maybe highlight? We just talked about patents, intellectual property, other assets that that potentially have had barriers or limitations, whether it was in traditional infrastructure or public blockchains, that could be unlocked by these hybridized structures.
Sure. Yeah, I think those, the permissions are extremely important, in these situations, right? There can't be a, like Renal said, something fully private or something fully public for most assets, right? Like it just doesn't work that way in the traditional world. It doesn't work that way for most assets, and it makes sense that it's done in this way. When it comes to assets that can be brought online, I think the first thing to think about is that 100% of all transactions and securities and assets will be brought online at some point. I don't mean like the banana we buy at the store is going to be brought online, but the buying, selling, of trading of options and things like that in the future of all sorts of assets will be. And even I think it was New York Stock Exchange CEO that said 100% of stocks will be tokenized in the next 10 years. And what you have to think about when you look at the space as a whole is that 10 years ago, when I was, actually, let me think. Yeah, about 10 years ago, when I was raising money for a startup, if you would have asked me if our startup had digitized its stock or its assets or its convertible note or whatever, I would have said yes, because every doc was docu-signed or some version of that. I never printed an actual document. I just had people e-sign it. And then there was a couple investors who asked if they could print it out and scan it and send it to me. But pretty much everyone just e-signed it in the system that I sent to them. 10 years before that, you asked a lawyer, they would have told you that's not even legal. Right? If you ask a lawyer today, would you rather DocuSign or a signed on paper? They would rather have a DocuSign, because that's more trusted with the timestamp, the IP address, the emails back and forth and confirmations and all that stuff that make it even easier to enforce in a courtroom than me saying, well, I don't remember signing that, or that person was drunk when they signed that contract, or whatever it was, right? So now you can see that in the courtroom, they look at technology as a lot of times a benefit. So if we look at something like that, and that's a bit of an extreme example, but then we look at the sort of selfish aspects of what can happen. When bonds, we had an advisor at one point, who was a previous, he's a friend of ours, he's a former vice chairman of NASDAQ, and he taught us, a bunch of young techies, about the traditional finance world, things we never heard of. But he brought up bonds to us at one point. And he said, did you know that when bonds went from calculating and distributing interest from annually to quarterly, bonds started trading at a 2 to 3% premium if they were calculated that way? And he said, imagine the world when bonds are distributed and calculated monthly. Imagine the world when they're calculated weekly. Imagine the world now where they're calculated daily. And if you think of some of the DeFi, the decentralized finance products that exist out there, they calculate and distribute interest every block on the blockchain, which is 3, 5, 10 seconds, right? So imagine holding your savings account on your phone, right, on a digital wallet, and watching in real time that ticker go up of your interest being calculated and distributed to you. If you were the person selling that financial product and knew that you'd get more liquidity, more investors, and be able to sell that product at a premium, would you digitize it? You absolutely would. And if you were a traditional bank who doesn't provide access like that, and you're Wells Fargo, who gives us 0.05% interest or whatever horrible interest rate they're giving today to their clients who they're essentially taking advantage of, imagine them having to compete in that world. They're going to start creating better products for everyone. And so I think that's where your imagination has to go in these things is yes, unique and weird and novel products that this technology can bring, but also just think back to the most basic of community banking, the most basic things that banks should be today, that banks started off as, micro payments and micro lending and communities coming together to build things. All these products will be now enabled on a whole new level because of blockchain. A community doesn't necessarily mean the 4 people who live in my condo building right here. It means whoever's in my community around the world, right? And that community can be based on geography, it can be based on asset classes or wealth levels or affinity groups. Like I'm super into the guitar that's behind Mrinal, and another dude on the other side of the world is, let's get together to do some kind of asset tokenization or invest together or community banking, right? That's what's enabled by all of this stuff. It's really a much bigger even picture than picking a single asset that's exciting. There is that too, though, which is exciting for all of us in our own respective career.
So something that you've both highlighted, and I'd like to explore further. I mean, when someone's considering an asset, whether this asset is, and they're looking for liquidity in that asset, whether they're looking to raise capital or make a secondary or an exit, and they're considering whether or not to, put an instrument on blockchain, what the benefits and drawbacks are. One of the key things that you guys highlighted is which permissions are ultimately given to the ultimate asset owner, whoever's going to own it and transfer it, and which permissions they or their counterparties might hold. And I think that this is one of the most critical things that there needs to be kind of a convergence on for this to work for large institutions, for institutional investors, for institutional issuers, because there are certain permissions that they simply are not willing to completely give over to the code, right? To have completely encoded on to the blockchain and be a fully public chain. But as Mrinal highlighted, there's certain things that if you take them away, you might as well just work with a normal database. What's the point of all this computational load and complexity when you're fully private, if you're fully permissioned, and so on and so forth. So Saeed, given your background as an institutional investor, having worked in treasury at a major institutional investor, what are some of the key permissions that you think institutions need to feel comfortable putting other types of assets into this technology? What are the permissions that you see staying, either with a trusted counterparty, be it a custodian or a network of custodians that may, have permissions on a blockchain? What are some of the permissions that you think need to stay with the user to really make the potential unlocked? Where is the balance between permissioned and permissionless, this hybridization of public and private, in order to make this something that really attracts the owners of the assets that people want to be able to put those assets in something that they're in a market where they're comfortable?
Yeah, great question. I think with regards to permissions, I think just as in the traditional world, if there are certain permissions that certain parties to a financial transaction should have, then those should really be maintained, and the infrastructure of the blockchain network or the blockchain protocols you're using should be able to accommodate for those permissions. So especially with Casper, when you have a private permissioned instance and you have a public, you're basing that as a layer on top of a public permissionless network. You have both the security and decentralization elements that will help in verifying, that these permissions will stay with specific owners or specific parties to a transaction. So I think, those traditional permissions that you see in the normal finance world, if those are maintained and kind of insured and verified on a hybrid solution, like I think I agree with what Mernal said. You definitely need to use both, all the advantages possible with a permissionless setting and also in a permission setting. So, if those permissions aren't maintained in the kind of digital world, then they definitely are not going to be, not going to be something that any institution will want to touch, because, they're not comfortable with that kind of permissions being either fully public or fully private or what have you. So I think, as long as that's maintained, and the infrastructure of the network you're trying to use can accommodate that, then that's a turning point, I think, and that's a big selling point for institutions to be able to kind of say, okay, we'll digitize all these financial transactions because we are comfortable that these permissions are maintained and these ownerships of the assets are maintained, and all the records are digitally maintained and secured and verified. So I think that's the main issue.
Well, again, I'd love to spend another hour on this. Our hour is already over. This has been a really interesting session. Again, Mernal, Alon, Saeed, it's such a pleasure to discuss these issues with you. We talked about how blockchain technology is accelerating cross-border transfers of assets, right? Not just payments, but transfers of all kinds of assets, and the potential for it to do even more. We discussed that there are revenue opportunities, that this actually could be, as Mernal said, making the pie bigger, and maybe again the amount of crust that the investment banker gets to take off the pie when it's cut is not going to be quite as much, but having a bigger pie is going to be in the interest of all parties, whether you're an intermediary, whether you're an originator, whether you're an asset owner, but that those of us that are intermediate transactions need to make sure that we're adding value. We talked about organizations creating liquidity around these assets, some of the key components that need to be there for assets to be liquid, that this isn't some magical solution where there's suddenly these built up pools of liquidity on assets that people don't ultimately want. There are several things that need to be conditions that need to be satisfied, none of them exclusively, in order to really unlock potential liquidity, but that once those conditions are met, that there is great potential for liquidity to be added to assets that are not currently efficiently liquid in the current or the historical and hybrid or I'd say legacy ecosystems that we've often traded assets on, particularly when it comes to cross-border. We talked about the hybridization of public and private chains, the permissions around it. We wanted to get into enterprises. We touched upon it several times, but as we're over time, we'll have to save that for another session. For everyone who was on, there were several questions in the Q&A that we weren't able to address. We did touch upon quite a few of them. A lot of them were similar to the questions that we had prepared as well, so we made sure to incorporate your comments and put a spin from the Q&A. We will share the questions that are remaining with the panelists, and we may those panelists may follow up with you to answer those questions after the session. Again, thank you guys all so much. A big thank you to Casper Labs for being the partner on this session. If you are, again, joining us on YouTube, please like this video, subscribe to the YouTube channel. Be sure to dial into our next AIM Summit webinar on the 29th of March, 4 p.m. Gulf Standard Time, 8 a.m. Eastern Time. We're going to be talking about disruption in traditional wealth and discretionary management. That's sponsored by Saxo Bank. Again, we have a great set of panelists. The last session that we did on this topic was met with a huge amount of interest. The Q&A was exploding, so we'd love to see you on that session as well. And again, thank you all for joining us.